The average true range is a great tool when it comes to adapting to the ever-changing market environment, being a useful indicator in measuring volatility. The average true range measures the price range of an asset. The higher the volatility, the higher the ATR. The average true range is one of the most useful indicators because it helps the trader deciding on where will set a stop loss or profit target, or if he even should open a trade in the first place. The ATR is measured as the greatest of any of the following three metrics: the value of the current high minus the low, the distance of the current high minus the previous close, and the distance of the current low minus the previous close. Despite the fact the average true range is not so common among traders, this indicator can assist them in entering and exiting trades. The ATR indicator moves up and down as price movements become larger or smaller. A new ATR reading is calculated as each time period passes. On 1-minute charts, a new ATR reading is calculated every minute. On a daily chart, a new ATR is calculated every day. All these readings are plotted to form a continuous line, so traders can see how volatility has changed over time. An asset's range is the difference between the highest price and the lowest price on any given day. The average true range reveals information about how volatile the asset actually is. High ranges reveal high volatility, while small ranges suggest low volatility. The ATR is basically an exponential moving average of the true range. Most common settings of this indicator are the 14-day ATR. Depending on their trading objectives or the timeframes, traders can use shorter or longer inputs of the ATR. Longer ATR will be slower and will generate fewer trading signals. Shorter ATR will generate a higher number of trading signals and will increase trading activity. For example, an average true range of only 5 periods wouldn't offer a large enough sample to generate an accurate indication of the true range of the security. An average true range of 50 periods would generate a more smooth average true range on the chart, with fewer and possibly high-quality signals. Let's assume that you are using a swing trading strategy and you're using an ATR with a 50-period input. You should keep in mind that if you're trading on the daily chart, the ATR indicator will indicate the average volatility over the past 50 days. However, if you are trading on the 4-hour chart, the ATR indicator will only display the average volatility over the past 54-hour candles. So the ATR's value differs from time frame to time frame. It's not a unique value. Now, how to read the average true range? First, the ATR represents a range indicator for filtering out trades. If you prefer volatile markets, or if your trading strategy is based on huge market moves, then ATR can filter out markets that are low in volatility. Even if you prefer calm, quiet markets, the average true range indicator will help you to filter out those periods of times that you would prefer to avoid. It's important to remember that the ATR doesn't measure the market direction. By tracking the average true range, a trader cannot identify the prevailing trend on the market. The ATR only tracks the magnitude of range, so it has limited use for generating accurate trading signals. It's a useful indicator only for giving an idea about how much the price may move in a defined time frame. Assume that the stock moves $1 a day on average. There is no significant news out, but price has already moved, let's say, 30% more than the average. And now you're getting a buy signal from a strategy. The buy signal may be valid, but since the price has already moved significantly more than the average, betting that the price will continue to go up and expand the range even further may not be a prudent decision. The trade goes against the odds. Since the price is already up substantially and has moved more than the average, the price is more likely to fall and stay within the price range already established. While buying once the price is near the top of the daily range isn't prudent, shorting is probably a good option, assuming a valid sell signal occurs. Now, very important, entries and exits shouldn't be based on the ATR alone. The ATR is a tool that should be used in conjunction with a strategy to help filtering trades. For example, in the previous situation, you shouldn't sell simply because the price has moved up and the daily range is larger than usual. You short only if a valid sell signal occurs, based on your particular strategy. Second, the ATR formula will assist you in setting profit targets. Knowing the average range is extremely useful since it allows the trader to estimate how much profit potential there is in the market. For example, There is no point looking for 200 pips of profit from a trade in a currency pair if the average true range for that market over the last 14 days is only 60 points. A simpler solution is to halve the 14-day ATR of the instrument and use this figure as your profit target. Thus, after entering a trade, you could set yourself a profit target of around 30 points. So how to trade with the average true range? The ATR indicator is useful to identify low levels of volatility. The average true range doesn't tell the trader anything about market direction. Don't get confused about the direction. If the average true range is going up on the chart, that doesn't mean that the trend is up. A viable strategy would be to search for low volatility levels in order to find a trade in the direction of the main trend. The first thing we need to do is to identify where the low volatility actually is. Keep in mind that the low volatility itself is not enough for a new trend. This translates into the fact that the current trend has run out of steam. It doesn't tell us that a new trend has begun. So we must use the average true range in conjunction with other oscillators or price action. For example, in this chart, we identified low levels of volatility, but we cannot enter the market blindly. A smarter approach would be to wait for the average true range to exit from that level and confirm the volatility increase with a trendline breakout on the chart, or a rising stochastic, for example, or a divergence on the RSI or the CCI, depending on your strategy. Second strategy involves using ATR as a trading stop loss. A trailing stop loss is a way to exit a trade if the asset price moves against you, but also enables you to move the exit point if the price is moving in your favor. Many day traders use the ATR to figure out where to put their trailing stop loss. Here's how it works. At the time of the trade, look at the current ATR reading. A rule of thumb is to multiply the ATR by 2 to determine a reasonable stop loss point. So if you're buying a stock, you might place a stop loss at a level twice the ATR below the entry point. If you're shorting a stock, you would place a stop loss at a level twice the ATR above the entry price. If you're long and the price moves favorably, continue to move the stop loss to twice the ATR below the price. In this scenario, the stop loss only moves up, not down. Once it is moved up, it stays there until it can be moved up again, or the trade is closed as a result of the price dropping to hit the trailing stop loss level. The same process works for short trades, only in that case, the stop loss only moves down. For example, say you take a long trade at a price of $10 and the ATR is 10 cents. You would place a stop loss at a price of $9.8, the 10 cents ATR multiplied by 2. The price rises to $10.20 and the ATR remains at 10 cents. The stop loss is now moved up to $10. When the price moves up to $10.50, the stop loss moves to $10.30, locking in at least a 30-cent profit on the trade. This would continue until the price falls to hit the stop loss point. Now here's an interesting indicator. In order to make it easier to visually see where those stops would be placed, you could use the ATR bands. This indicator will show an upper and a lower band around the price, showing where you can put your stops or trail them in open positions. You can use ATR bands in a number of ways. It's an easy visual way to see where you could place your stop loss. You can use a multiple of ATR as your target, and you can trail your stops alongside the ATR bands. ATR bands indicator has only two variables, the period and the multiplier. By default, ATR period is set to 24, with the rationale that one day has 24 hours, so that way we're getting the average price movement for the past day. However, if you're day trading, it could be useful to have a shorter period ATR, for example if you want to make recent price volatility more relevant. ATR multiplier also depends on your trading style. Let's say your current ATR value is 20 pips and you use a multiplier of 2. Then the bands will be 40 pips on each side. If you use a multiplier of 3, the bands will be 60 pips on each side. There is no universal rule for setting stops according to the ATR. It depends on each trader's individual risk tolerance, while also allowing the trade breathing room to develop. So backtest and choose the settings that are in line with your strategy. As you probably know, one of the most important aspects of trading and investing is having a disciplined risk management process, Because the ATR doesn't measure direction and simply considers the magnitude of range, it has limited utility as a means for generating trading signals, but is a useful tool for providing an idea about how much a market may move, and will help you to apply a proper position size and a proper stop placement. If you learned something new and found value, leave us a like to show your support, subscribe to our channel and click the bell icon to stay notified when we release new videos. Until next time.